HMRC tax changes are going to catch millions of small DIY investors in Britain over the next 2 years. We look at the tax tsunami coming your way and give our 4 top tips for avoiding it. Hi, I'm Marcus De Silva and welcome to the Steps to Investing YouTube show, helping you beat high inflation with simple tutorials and strategies that get you investing in the stock markets and earning a better return. Please like the video and subscribe to the channel and turn on notifications. Also, if you've any questions, just leave them in the comments box below. We'd love to help. Chancellor Jeremy Hunt has introduced lots of tax changes this tax year that are directly affecting millions of small investors here in the UK. In particular, this tax year, he has reduced tax-free allowances for capital gains and dividends. And come April 6th, 2024, he will be reducing them again. It means lots of people who aren't currently paying any tax will be dragged into the tax net as the Exchequer sets its sights on everyday DIY investors. It comes as our finances are being pummeled from multiple angles, with freezes in income tax bans, as well as lots of other tax changes that are leaving Brits worse off in the middle of a searing cost of living crisis and painful interest rate hikes. We've been chatting to our friends at broker AJ Bell and identified 4 really easy ways for you to sidestep the oncoming tax tidal wave and keep more of your returns. Shall we take a look? Just before we do, don't forget to like the video and subscribe to the channel. Let's get going. So, as I said, the Chancellor has introduced numerous tax changes this tax year that are affecting millions of us Brits. In particular, there are 2 that affect private investors. So those of you who might be investing for long-term financial goals, such as retirement or buying a house. Number 1, taxes on dividends. So the first big change is taxation on dividends. That's the income you receive from shares. So if a company makes some profits, its board might decide to pay out some of those profits to shareholders in the form of a dividend. Now, you are allowed to receive a certain level of dividends before you are taxed, and for many years that was £2,000, but in this tax year it has just been halved to £1,000, and next tax year, 24-25, it will halve again to £500. Now, you might be thinking, okay, but does this really impact that many people? Well, according to a Freedom of Information request submitted by investing stockbroker AJ Bell, HMRC expects 1.8 million Brits to be dragged into paying taxes on dividends over the next 2 years alone. And that's just investors who will be paying dividend taxes for the first time. If we include those who were already paying dividend taxes and are now facing increases, then the total number of Brits affected by the dividend tax changes rises to 4.4 million people over the next 2 years. That's 6.5% of Brits. The second big change is to taxes on capital gains, which refers to growth in the value of your investments. So for example, if your shares were to rise in value from 100p to 120p. If you sell investments and book a gain, you will pay tax at a rate of 10% if you're a basic rate taxpayer, or 20% if you're a higher rate taxpayer. For property, there's also an additional 8% surcharge, so 18% or 28%. Similar to our lovely dividends, the government gives you an allowance of capital gains that you may accrue within a tax year before you have to pay capital gains tax, CGT as it's commonly known. Well, this year the Chancellor has also cut this allowance from £12,300 to £6,000, and next tax year, come April 6, 2024, it will be slashed again to £3,000. How does this impact us? Well, again, according to figures from AJ Bell and HMRC, 260,000 people will be paying CGT for the first time by next tax year, with basic rate taxpayers forking out an additional £930 and higher rate payers an additional £1,860. And there's one more annoying issue. Given that millions of us are about to be scooped up in the tax net, it's not just about paying tax that's the problem. It's calculating what you owe. In particular, CGT calculations can get very confusing very fast. Granted, buying and selling entire holdings is not too bad. The problem comes when you buy and sell portions of your total holdings, or you invest in what they call accumulation units. These effectively come with a broker order for your share dealing service to automatically roll up any dividends you receive from a company and buy more of its shares. Well, that has tax implications. So the tax man has sharpened its sights and it's affecting millions of small shareholders. So is there anything we can do? Just before we get on to our 4 top tips, please don't forget to like the video and subscribe to the channel and turn on notifications. Right, so how do you defeat the wealth tax tsunami? Our 4 top tips. Number 1, use individual savings accounts or ISAs. ISAs are government incentivized financial accounts used for savings and investments. Much like a bank account, you simply open one at your share dealing service, credit it with some money, and then start looking for financial products to invest in, such as investment trusts. The only limitation is that each tax year, the maximum you may contribute into an ISA is £20,000. What's particularly important and relevant to the tax tsunami is that they are completely free of taxes. No CGT, no dividend taxes, and also no taxes on interest from bonds or savings. So it doesn't matter how big the value of the account grows or how much income it pays out, the taxman can't touch it. Even if you become one of the UK's 2,000 odd ISA millionaires, there's no tax to pay. For those of you who already have investments in plain vanilla share dealing accounts, sometimes called general investment accounts, and wanting to use the ISA structure, then there's a process called bed and ISA. This is where your share dealing service will sell down your investments in your regular account and rebuy them for you within an ISA wrapper, just to make it really simple. Now, of course, you may still be liable for taxes when those investments are sold outside of an ISA, but your tax-free allowances may cushion the blow. Of course, the longer you leave it in the tax year, the greater those tax liabilities may grow. So get in there early. Number 2, use up your pension allowance. Just like the ISA, private pensions such as the self-invested personal pension, the SIP, are also completely sheltered from any tax. And on top of that tax protection, come with generous tax relief too. This is because the government is encouraging us to save for our retirements. It means for basic rate taxpayers, the government will top up your pension with a 25% bonus. And higher and additional rate taxpayers are able to claim extra relief through their tax returns too. Of course, there are limits as to how much you can contribute each year, but this tax year, the government has become more generous. Annually, you are now allowed to contribute £60,000 per year, up from £40,000 last year, and the lifetime limit has also been scrapped. Also worth mentioning is that there's one further neat trick to reducing CGT and dividend taxes if you're invested outside of a wrapper. If you've just tipped over into the next income tax band, so you're now paying a higher rate, then you can use pension contributions to bring you back down below it, which means the percentage you pay on CGT and dividend taxes may be lower. Because if you remember from earlier in the video, the rate you pay is linked to your income tax band. Number 3, transfer money to a spouse. Okay, our third tip is not to forget to use your spouse's allowance. Investments transferred to a spouse are exempt of CGT and dividend taxes, which means you can potentially benefit if they haven't used up their allowance within a particular tax year. What's more, there may be a double benefit if they're on a lower income tax band, as similar to our pension contributions, it may lower the percentage rate of tax that you owe. Number 4, use your losses to offset capital gains. On to our fourth and final tip. Whilst we hate losing when investing, for CGT purposes, losses can actually be quite useful, as you can use them to offset gains and lower your tax bill, which is fair, because on balance, that's how wealthy you are left. Not only that, you may also carry forward any losses to offset capital gains in future tax years. All you need to do is register the loss with the HMRC within 4 years of the tax year that you made it. I hope you enjoyed the video and found it useful. Of course, any comments, please just leave them in the comments box below. For investment broker reviews, podcasts, and blogs, please go to stepstoinvesting.com.